Many people avoid investing because they believe they need thousands of dollars to get started. Others simply don't know where to put small amounts of money. The truth is that building wealth does not always begin with a large investment. What matters most is getting started and choosing the right place for your money based on your financial goals. In this video, I will share 5 smart ways to put small amounts of money to work. These are not get-rich-quick strategies or guaranteed profit opportunities. Instead, they are practical, lower-risk options that many investors use to earn income, preserve cash, or grow their savings over time. Because interest rates and investment returns change regularly, always check the latest rates, fees, and terms before making any financial decision. The first option is U.S. Treasury bills. U.S. Treasury bills, often called T-bills, are short-term government securities issued by the U.S. Department of the Treasury. They are backed by the full faith and credit of the U.S. government, making them one of the most conservative investment options available. Treasury bills are offered with short maturities, ranging from a few weeks to 1 year, allowing investors to choose a time frame that fits their needs. Instead of paying regular interest, Treasury bills are generally purchased at a discount and redeemed at their full face value when they mature. The difference represents your investment return. They are often used by investors who want to protect their cash while earning more than they might receive in a traditional checking account. Why it works: government backing, short investment periods, and predictable maturity dates. The second option is a high-yield savings account. A high-yield savings account is one of the easiest places to begin putting your money to work while keeping it readily available. Unlike many traditional savings accounts, high-yield accounts often pay significantly higher interest, although rates can change over time. Most accounts offered by FDIC-insured banks protect eligible deposits up to the legal insurance limits, giving savers an extra level of security. Because your money remains accessible, a high-yield savings account is commonly used for emergency funds, short-term goals, or cash that may be needed in the near future. While it may not generate the highest returns, it offers an excellent balance of safety, flexibility, and consistent interest earnings. Why it works: low risk, easy access to your money, and ongoing interest on your savings. The third option is a money market fund. A money market fund is a type of mutual fund that invests in high-quality, short-term debt securities and other cash-equivalent investments. Many investors use money market funds as a place to temporarily hold cash while earning income and maintaining liquidity. Although money market funds are generally considered lower risk than many other investments, they are investment products, not bank savings accounts. Unlike bank deposits, they are not protected by FDIC insurance and can involve some investment risk. Money market funds are often used by investors who want to keep their money relatively accessible while potentially earning more than they would in a standard checking account. Why it works: liquidity, focus on income, and relatively conservative investment strategy. The fourth option is a no-penalty certificate of deposit, or no-penalty CD. A no-penalty CD offers a fixed interest rate for a set period while providing more flexibility than a traditional certificate of deposit. Many financial institutions allow customers to withdraw their full balance after a short waiting period without paying an early withdrawal penalty. This makes a no-penalty CD a useful choice for people who want a predictable return, but still appreciate having access to their money if their plans change. Features and withdrawal rules vary by institution, so always review the account terms before opening one. Why it works: fixed returns, greater flexibility than many traditional CDs, and relatively low risk. The fifth option is an ultra-short bond ETF. An ultra-short bond exchange-traded fund, or ETF, invests primarily in bonds with very short maturities. These funds are designed for investors seeking income while keeping interest rate risk lower than that of longer-term bond funds. Unlike savings accounts or treasury bills, the value of an ETF can rise or fall throughout the trading day. While ultra-short bond ETFs are generally less volatile than many stock investments. They are still subject to market risk and should not be viewed as risk-free. For investors who want a balance between income potential and liquidity, an ultra-short bond ETF may be worth considering as part of a diversified portfolio. Why it works: income potential, easy access through the stock market, and lower interest rate sensitivity than many longer-term bond funds.